Chief Economist and Global Head of, of Economies with Morgan Stanley joins us. Chetan, good morning. Thank you for joining us. Chetan, in your view, where is the Indian economy headed versus the global economy, given that we are in a strong growth patch? And why would you bet more strongly on India versus rest of the world?
So essentially what we are highlighting is that India's GDP growth will accelerate to 7% over the next 4 years. The debate was whether the initial recovery that we've seen in India, the V-shaped recovery that we've been talking about globally as well as in India, has come through. Now, is this recovery just the pent-up demand or it's going to be sustained? And that's why we are arguing that it will be sustained and we see that 7% growth over the next 4 years. Now, as in contrast to the rest of the world, you know that there are issues related to income inequality that has been catching the attention of policymakers and they're having to respond. So we are seeing policy actions being taken in the US as well as in China, where they are taking measures to compress the corporate profit to GDP over the medium term. Whereas in India, because the government still has to ensure that there is enough job creation and the investment to GDP needs to go up. Government is trying to take measures which is incentivizing corporate profit to GDP to rise, and therefore it's a different backdrop that India is in right now relative to the rest of the world.
How do you see the fabric of global economy changing with what China is trying to do? China is consciously trying to slow down their economy. China is the big factory of the world. China is the big consumer of the world. Now, if the changes which Chinese administration is doing, if they are far-reaching and impactful, how will that change the equilibrium?
So when you're thinking about the external environment for India, what you have to remember is that in this cycle, US has taken the role that China took post-2008. So when we compare the debt to GDP delta, which would be sort of measuring the aggregate fiscal and monetary stimulus impact on the economy, we are seeing a bigger rise in debt to GDP in the US in 2021 and 2022 compared to what China is going to take up. And so first is that is an important point. And it's not just the US, but even Euro area and other big parts of the world are seeing a very different recovery in this cycle. So we think that when you take the global picture in aggregate, you are going to have a pretty strong exports trend for India and for the rest of the region too. And one other thing which has changed in this cycle is that COVID has triggered greater focus on outsourcing. And so India's software services exports has also got a boost, much similar to what we got after Y2K in the 2000s. So when you take both these points together, we are still quite confident that India's exports will be relatively strong in this cycle versus what we have seen in post-2008. Just to give you the backdrop of global trade numbers were 6% on an average in 2000s. And in post-2008, almost over a 9-year period, global trade average just 1.2%. Whereas right now, we are expecting global trade to be somewhere in the range of 5.5% over the next 2 years. So that will be a very different external demand backdrop for India.
Good morning, Chetan. So if you are seeing India enter a new virtuous cycle when it comes to CAPEX, when you're expecting a new profit cycle in India as well, in all of your conversations, are you seeing investors also recognize that? I ask you this because in a recent note, you talked about the disappointment maybe over the last 10 years, but how India now stands out.
So at this point of time, investors are paying attention to India, as you can see from the way the capital markets are. But we still think that there is skepticism about sustainability of India's growth story. And that's the reason why we put this note out and we are taking the other side of that debate that India will actually deliver. So yeah, there is a active debate going on amongst investors about sustainability of this recovery, which India has seen already.
And what are your expectations from this new cycle of this new profit cycle in India?
So our expectation is that effectively what will happen is that with the recovery in external demand, you will see initially operating leverage benefiting corporate sector and boosting their profitability. But as capacity utilization improves, they take up investment growth, and that will be the next leg of the corporate profit to GDP improvement, with CAPEX helping also improve productivity growth. And that is essentially going to lead us to an environment where GDP growth will be averaging around 7% over the next 4 years, which would be not exactly the same numbers that we saw during 2003 to 7, but the overall direction and the dynamic in the economy will be similar to what you saw in 2003 to 7 for India.
You were talking about how the policies of this government, unlike the mature economies, stands out because we are, consciously trying to raise income, this, that, and the other. One of the mega trends that's being talked about is the comeback of the manufacturing sector. I believe you folks have also written about this and how this is part of the new virtuous cycle. Have you already started to see that? Have investors started to recognize that?
We're seeing early signs of it in terms of manufacturing, which is manufacturing investment coming in from the foreign side. And FDI in India has been relatively strong. But to see like a major shift where India really becomes a more active manufacturing base, that is yet to happen. But we would see that trend evolving over the next 2-3 years. And remember that domestic demand in India has also been weak for all these long number of years. As domestic demand picks up and the domestic opportunity also becomes more attractive, you will see a pickup in manufacturing investment from the multinationals. And the domestic corporate sector will also be more confident to invest once you see that sustained increase in sales growth for them, with GDP growth remaining high at the range of about 7%.
Just to stretch the point forward, Chetan, that you were earlier alluding to, your report, your recent note comes at a time when inflation globally is high, and interest rates going up is actually a matter of when and not if anymore, I guess. This is a time when cheap capital actually runs away. What I want to understand is, isn't that going to be a challenge then for developing markets like India?
So, if you're trying to think of comparing this situation related to 2013, there is a lot that is different in this cycle. Firstly, the Fed itself is tightening at a much later stage, or rather withdrawing accommodation at a much later stage of the business cycle. The US unemployment rate is much higher right now versus much lower right now versus what it was during 2013. So the strength of the US economy itself is in a very different position when the Fed is deciding to take the decision to taper its purchases. More importantly, emerging markets and India have a very different macro stability position. So India's inflation has been well behaved. During 2012, last quarter of 2012, India was running a current account deficit of over 6%. Right now, we have current account balance on a 4-quarter trailing basis running around surplus. So we have a very different macro stability dynamic that is in place right now. And so we don't think that the tapering decision taken by the US Fed is going to have significant impact on India or emerging markets. And when the Fed does decide to take up rate hikes, and Fed futures are currently pricing in that by December 2023, US policy rates would be in the range of 1.4%. Even when it is at 1.4%, underlying inflation will be around 2 plus. You're talking about Fed still operating with negative real interest rates. So we think that as long as the Fed decision to take up rate hikes is done in a gradual manner and not in a disruptive manner, India should be able to manage in this environment. And again, I would like to draw the comparison with 2003 to 7, when the Fed was constantly hiking, and you still had India's growth story, well maintained. We did not have a challenge when the Fed was tightening. And this cycle is, in that sense, very similar to 2003 to 7, because what is different is you have a very different external demand backdrop. So as long as exports are doing well, you can take for granted that the current account balance will be well behaved, and therefore you would not have too much pressure when the Fed is taking a withdrawing decision for withdrawing accommodation.
Interesting. So just an extension to that point, given that, the RBI Governor Shaktikanta Das has now got an extension of another 3 years, do you think the Indian Central Bank will remain in an accommodative stance? Will they continue to be growth propellers, or do you think they will turn to being inflation warriors anytime soon? And how soon do we see India actually move on rates?
So for India, we think that the central bank will begin to hint that they are withdrawing accommodation. They've already taken one decision to make the adjustment to the asset purchase program. But we are expecting that the RBI will probably hike the reverse repo rate in December and hike the repo rate in February 2022. So we are expecting RBI to begin to move in that direction, because currently, if you look at the effective policy rate, which is in the range of around 3% and inflation around 5%, you have 200 basis points negative real interest rates. And that was needed to get the economy back up and on a good path. But now we are having enough evidence that the economic recovery is strong. And therefore, we think that the RBI will begin to move in the other direction and withdraw accommodation. And so we are also expecting them to take up policy rates up by about 150 basis points in 2022, which is a bit much more, it's somewhat higher than what the consensus is thinking right now. But our approach on this is that even with 150 basis points of rate hike that RBI takes up in 2022, we would just still be barely getting to zero real rates. So that's the path on RBI's actions that we are expecting. And as long as this is, again, done in a gradual manner, we think India will be able to take, or the economy will be able to take these rate increases that we are forecasting.
Interesting views there, Chetan Ahya. Great to have you on the show today. Thank you so much for taking the time out.
My pleasure to be with you.